It is a process of choosing political candidates for the fall, of strengthening the coalition confronting Russia, but most of all, of coming to terms with a tightening Fed. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers of Harvard on what can get the job done on inflation.
This is a feature, not a bug, associated with the tightening of monetary policy.
And Tom Shapiro of GTIS Partners on risks to the housing market as interest rates rise.
The consumer is stretched, and that is certainly going to be an issue on a going forward basis.
This week we did a lot of preparing to add Sweden and Finland to NATO when the leaders of the two countries paid a visit to President Biden at the White House.
Well, it's incredibly historic. This completely reshapes the post-Cold War security alliance in Europe.
Finland and Sweden make NATO stronger.
Preparing for midterm elections less than 6 months away as 5 states held primaries. Though in Pennsylvania, Republicans have some more work to do, as Senate candidate Dave McCormick explained.
Now we have tens of thousands of mail-in ballots that have not been counted, but we can see the path ahead. We can see victory ahead.
But no one, and I mean no one, is preparing harder than Fed Chair Jay Powell, preparing for the next round of rate hikes.
Inflation is coming down. That's what we really need to see. Honestly, we will go until we feel like we're at a place where we can say yes, financial conditions are in an appropriate place.
Equity markets this week believed the chair, and if that weren't enough, then chilling news out of retailers like Target and Walmart reinforced the idea that harder times may lie ahead. With the S&P down for the 7th week in a row, the longest losing streak since 2001, and though it flirted with a bear market, it came back late on Friday, ending just above 3,900, down 3% overall for the week. While the Nasdaq, already in bear territory, was down another 3.8% this week. But the bond market was a different story, with the 10-year rallying for the second week in a row, ending up with a yield below 2.8%. To help us sort it all out, we welcome now Bob Michele. He's CIO of Global Fixed Income, Currency, and Commodities at JPMorgan Asset Management, and Saira Malik, Chief Investment Officer at Nuveen. So welcome, both of you. It's great to have you here. Saira, I'm going to start with you, because there was so much activity in equities this week. What happened?
David, there was 3 key drivers for the market this week. First was the retail wreckage, which shocked investors on Wednesday because we saw demand destruction. Consumers are not willing to pay anything for goods anymore. And secondarily, we finally did see that shift in spending from goods to services, but it came with a healthy dose of inventory building up on the goods side. This is not good for retailers' business model. Second is manufacturing data. After a great payroll number in April, strong industrial production numbers, yesterday, the Philly Fed Manufacturing Index significantly misses numbers. There's cracks in the economy, but it's not all doom and gloom. Investor sentiment's very negative. Markets are down almost into bear market territory. Valuations are starting to look attractive. And down stock markets and some demand destruction could give the Fed the ammunition it needs to finally take its foot off the gas in terms of interest rate hikes, but we don't expect that till at least later this year after they see some more data.
So, Bob, Saira says maybe the Fed can take its foot off the gas on interest rate hikes. What did we see in the bond market? Because we had seen that really dramatic ramp up in the yield on the 10-year, and then it sort of plateaued the last couple of weeks.
Well, David, unlike the equity market, the bond market actually found solid footing this week. And it all started when Fed expectations of rate hikes settled at around 2.75% at year-end. I know that's 2% from where we are now, but earlier this month it was at 3%, and the concern was that it was headed north to 3.5% or higher. Once Fed rate hike expectations settled down, the Treasury market settled down. You said we're at 280. Last week we were at 320, and again, the concern was that we were headed to 350. It feels as though the market is getting very comfortable with the narrative that the path to a 3% Fed funds rate will be enough for now to slow down growth and inflationary pressures, or at least get the Fed to pause. Now, look, I'll admit, it wasn't a perfect bond market. Corporate credit still had a tough week. Thanks very much, equity market and Sarah. It was the lousy earnings that Sarah talked about. And we had high yield yielding now 8%. It started the month at 7%. But overall, good week for the bond market. If Fed rate hike expectations and the 10-year yield settle around where they are, that will ultimately create support for corporate credit, and that should spill over into other asset classes.
Bob, what are we seeing in the underlying economy, as it were? When you look at those retail sales numbers from Target and from Walmart and things, some people are saying this is different from just a rate hike concern. This is a concern about the strength of the consumer, that basically they are not buying as much, they can't buy as much.
Well, we're looking at it from a credit perspective, and what we're seeing is exactly what companies said they would see this year, that they were seeing higher input costs. They were going to pass some of that along. They were going to absorb some of that in their margins. We're seeing that. The top line at a lot of these retailers was actually still very strong. It was up there. And I think the other thing that gets lost in all this is perhaps the consumer is shifting its spending patterns. It's shifting away from the retail, and it's doing more in travel and leisure.
I agree with Bob on the bond market. I think it is leading the way. When equities were starting to catch up today, we did close in much better territory where we were. We could see a bear market rally, and we did see short covering this week. But with the retailers, I'm less constructive because that inventory build in goods on their balance sheet is going to be an issue. I think consumers are saying we're not going to pay anything for goods going forward. There's going to be winners and losers in the retail sector. For example, Costco. This is a winner, though, going forward. They have a more resilient business model, lower price points, and they have that subscription business, which gives them stability. They can raise prices there to overcome inflation, and raising prices is going to be key for companies in order to preserve their margins going forward.
Look, I think for sure, Sarah, that higher energy prices, higher gas at the pump, higher food prices are eating into consumer budgets. But we still have to look at very low unemployment. We've got wage gains going up at the fastest rate in decades. It feels, after a little consolidation in here, that perhaps the consumer will return to spending more broadly.
Well, but does that cut the other way to some extent, Bob? Because if it's really going up that fast, the Fed may need to go further in rate hikes.
Well, I think certainly that was the narrative last month, that there was no high that the Fed could reach that would be high enough. It feels like we're seeing some pause in housing. There's enough evidence that things might slow down with higher rates and perhaps the liquidity withdrawal, that 3% is a good target for now.
Sarah, one of the concerns has been valuations when it comes to equities. It's been, some would say, fully valued. I guess that's the polite way to put it. Is that out of the market now?
Not completely out of the market. Equities are mostly pricing in a soft landing and somewhat pricing in a mild recession. And if we were to hit a deeper recession hard landing, we've not priced that in yet. We could see equities go down another 10% in that scenario. That is not our base case, though. Valuations are about between the 5 and 10-year average at this point. So this is where you need to start looking for quality companies with strong balance sheets that are trading on sale. Another area we like actually are growth stocks, which are very unpopular right now, but they're significantly declined. There's a lot of great companies in there. For example, even in the FANG sector, Microsoft, they have a 1% dividend yield. Dividend growers tend to outperform in higher rate environments. Huge total addressable market, strong enterprise demand, strong cloud demand. We're looking for opportunities in companies such as those, given the declines year to date.
Bob, Sarah raised it, recession. How do you see the likelihood of recession? I think most people I've talked to, not over the next 12 months, but you go out 24 months, it's different.
I think when you look at the next 12 months, in the U.S., you still have to get through the summer where there's a lot of pent-up demand for travel and leisure, and unemployment is still very low and wages are going up. I think when you start to get out 18 to 24 months, then you're looking at a lot of things. You're looking at where rates will be, the cumulative impact of rate hikes. We think they'll be about 3%. You're looking at the bite that inflation will have taken out of the economy. You'll have another year and a half of higher inflation than the consumer would like to see. You'll have a strong dollar. You're also going to see the liquidity withdrawal from the Fed. So 2 years out, our probability of recession goes up to 55%. It's still possible for the Fed to engineer a soft landing, but frankly, it looks very aspirational when you figure they have to battle the highest rate of inflation in 40 years and drain away the greatest amount of liquidity we've seen in the history of Earth.
We're still more optimistic, Bob. We're between a soft landing and perhaps at worst a mild recession. But the demand destruction that we're already seeing, cracks in the housing market, those together, plus the 20% or so decline in the stock market, we do think that that could be one of the reasons in a few months from now the Fed has said they're data dependent. They could start to lower the number of rate hikes that they're doing and help us avoid that worst case scenario of a recession.
So David, there you have it. 2 years out, a lot of people are saying it's a coin toss. Someone in the equity side sees the optimism, a bond guy sees the pessimism.
Yeah, but my question basically, Bob, is if in fact the Fed decides it's really getting troublesome, so I'm going to have to back off on the rate hikes, where are we with inflation? I mean, is there a danger here of getting off the antibiotics a little too early? We don't have the infection gone.
Well, I think we don't want to acknowledge that Chair Powell already told us that if it comes down to growth or inflation, their battle is against inflation, even if it means avoiding a recession is unavoidable.
So, Sarah, if Bob's right, what does that say to equities?
I think, for equities, it definitely leads to more downside. In a recessionary environment, they have not priced it in. But that's also why we're looking for those companies that are less dependent on economic growth. That does lead us to growth stocks. They have some of the worst returns year to date. And then also fundamentally strong sectors. Energy is a sector we still like because of the fundamentals. Tight supply, demand should remain reasonably strong, and producers are being very disciplined. And then finally, dividend growers. If you look at history, companies that have strong balance sheets, cash flow, can continue to grow their dividends. They'll give you that portfolio protection within equities and should perform quite well while the Fed raises hikes and be defensive during a recession.
Okay, Sarah and Bob are going to be staying with us because we want to put some money to work here. We're going to ask them for some investment advice, given what we are seeing in this tumultuous market. That's next on Wall Street Week on Bloomberg.
This was the week when the stock market staged what it euphemistically calls a correction, plunging below the 1,000 mark for the first time since mid-November, and came amid growing investor concern over the state of the dollar at home and abroad. Domestically, how much it's going to cost in terms of escalating interest rates on the dollar, and abroad, how much it's going to be worth in terms of other currencies, whose relative value was on the rise.
That, of course, is Louis Rukeyser on Wall Street Week nearly 50 years ago now, reminding us of the similarities and, for that matter, the differences as well between then and now. Saira Malik of Nuveen and Bob Michele of JPMorgan have stayed with us. So, Bob, let me come back to you. It is a different time, although there are some similarities. I'm not sure whether there's a correction or we're actually seeing a downright bear market right now. But let's talk about investment in fixed income. Where are there opportunities from your point of view?
By the way, I hope it's a correction, because if I'm right, I think it took about 10 years for the Dow to get back up above 1,000 from that taping. Look, when we look at the repricing in the bond market, it's been dramatic. For the first 4 or 5 months of the year, it's been the worst bond market in history by a lot of measures. We want to take advantage of that. We think it's gone too far. I was in Kentucky visiting clients actually yesterday. There was a lot of discussion about municipal bonds. And there are a lot of individual and institutional investors that are looking at muni bonds yielded 1% at year end. They're now yielding over 3%. On a taxable equivalent yield, that's about 5%. And municipal finances actually look pretty good. The other area that we're getting back into that looks pretty attractive to us, I touched on earlier, it's high yield. You're at an 8% yield. You were at 7% at the start of the month. You were 4.5% at the start of the year. A pretty dramatic repricing, and I think a lot of investors have just fled the market and forgotten that it's a cleaner market. 6% of the market defaulted away in 2020. You've got a lot of middle America industrial companies in there with great fundamentals. To me, that's where a lot of value exists.
I want to come back to high yields, but Sarah, what about munis? Because I think you're interested in those as well, right?
Yeah, for fixed income in general, rising rates are going to be a headwind, but similar to Bob, we don't see rates rising to the degree that they have year to date. So for fixed income, there are areas where you can lean in. Municipal bonds do have strong fundamentals. At the front end of the curve, we're seeing high yields. And in taxable fixed income, we like corporate credit, those companies and sectors with strong balance sheets, but also emerging markets and high yield. You're getting a good return now, much better than you did in the past. So all of those are areas that we like in taxable fixed and munis.
So I'm really curious about the high yield because there's a lot of talk about the spreads, as they say, blowing out on high yields. So you don't want to be in high yields when that happens. Are you confident that's not going to happen? And when you have rising rates, don't you have to be worried about some defaults?
You have to worry about defaults right before recession. And our analysis shows that any backup in high yield credit spreads is a buying opportunity unless a recession is imminent. Expecting 1-2 years out isn't imminent because we know anything can happen. So for us, credit quality still looks great. The yield is there. There's a lot of money on the sidelines that needs to put yield into their portfolios. As long as things remain stable, we think that money will come in and support the market.
Sarah, you mentioned earlier some of the equities you're interested in. You mentioned energy, for example. You mentioned Microsoft, maybe Costco. What makes you interested in those particular sorts of equities?
So within energy, we love the fundamentals of the sector: tight supply, strong demand, producer discipline. Particularly refiners, we think, can benefit at this point in the cycle. Within the FANG stocks, we don't think that they're dead. You just need to be selective. Look for ones with less competition, more of a unique business model. Not only Microsoft, but Amazon. They had a very tough quarter, but they've really, in a sense, overinvested in their logistics. They have so much control over their global distribution. It's going to be a positive for them and pay off in the long term. We don't look at Amazon as a post-pandemic stock that's just going to suffer from here. Other areas of equities, consumer staples is an area where people tend to hide during periods such as this. They have very low growth rates, though. Valuations are high. That's not a place that we would be looking. If you want protection, look for those companies with strong dividends where they have the balance sheet strength to continue to increase those dividends.
So Bob, on the fixed income side, is there a corporate bond sort of tracking of what Sarah just said on the equity side? Are those the corporate bonds you're most interested in?
I think it's just so broad-based now. Everything got thrown away. I wish I could say there was a particular market or sector, but everything cheapened up so dramatically. It's just a matter of going in, having the nerve to buy when everyone else is selling, and just hanging on for a little bit and ride through the volatility.
But what if, in fact, there is more of a chance of recession than we're anticipating? How do you hedge against that? How do you protect yourself, Bob?
Well, I think there are a couple of things. One is you have to go up in credit quality because if, in fact, we do go into recession, then you are going to see default rates go up. Then there's going to be a flight to quality. So not only do you want higher quality corporate bonds, you want government bonds again, regardless of the yield. We've seen that yield could be anything in the government bond market, and then you want to still stay in the dollar. So those are the kinds of things where you would go to if recession became really probable near term.
So, Sarah, what about the dollar? I mean, we heard there Mr. Rukeyser 50 years ago talking about the dollar. Boy, we've had a very strong dollar. This week we saw maybe a little bit of a backing off on the strength of the dollar. Do you have a theory on the dollar, and how does it affect your investment strategy?
Well, I hate to say anything different than Lou Rukeyser, but we're in the camp that the dollar should remain pretty strong. The U.S. is a safe haven trade. There's so many geopolitical risks out there, from the Russia-Ukraine situation to the lockdowns in China and the supply chain issues that they're having, and also can that monetary policy really have an impact? So we're very selective non-U.S. We only like Latin America at this point in emerging markets. Dollar remains strong as the U.S. raises interest rates. We think that, at best it's flat. That likely remains pretty strong going forward.
Sarah, I also want to ask you the same question as Bob. On the equity side, for example, if you thought there was a larger chance of recession than you've said so far, how would you hedge against that?
Well, first of all, I think market timing is a loser's game. The market can turn on a dime. We've seen that happen consistently this week. So we don't recommend people trying to get in and out of the market. This is where you need to be diversified, disciplined, averaging into the market. And then you just need to look for those companies that are resilient in those sectors where they can continue to perform well because they have the profitability, they have pricing power to overcome inflation, strong free cash flow, strong balance sheets. That's where we'd be positioning in equities, stay out of, unprofitable technology companies where, they might have a hard time surviving during a deep recession.
And Bob, sort of finally, Warren Buffett and others have said you want to buy when others are selling and the reverse, right? Right now, as you look at the marketplace, where are people selling that you'd like to buy? They're making a mistake.
Well, I think we talked about corporate bonds. I think that was a big mistake. I think there was a lot of selling of municipals. I don't think that was a mistake. I think that was the technicals because they had to raise cash to pay capital gains taxes at the start of the year. I think some of the emerging market debt sectors look pretty attractive to me.
I'm glad you raised that, because I was going to ask about outside the United States. You think emerging markets might be attractive on the fixed income side?
Yeah, because they've gone through a rate adjustment. If you look at the U.S., we've done 2 rate hikes for 75 basis points. If you look at the emerging markets since the start of 2021, we've had something like 130 rate hikes for a cumulative 11,000 basis points. There are high real yields there. They front run the inflation. They're in a good spot.
So, Sarah, same question to you. Whether it's debt or equity, emerging markets do you find attractive? Some people say this is a time to move into them. Others say they've got a lot of external debt.
I'm going to agree with Bob and say emerging markets debt over emerging markets equity. I think you're getting more for your yield there. Emerging market equities are tough because of what's happening in China. The impact of Russia and Ukraine on European equities, we're very selective there. India looks somewhat fully valued to us. So we're finding most value in Latin America, which is out of the fray. But it's a challenge for equities in emerging markets at this point.
Let's sneak one last one in quickly, Bob. What about China? At the very end of the week, they really cut their rates, particularly mortgages. Is that good news for the world?
No, it's bad news, and I think you have to look at it and think that the probability of stagflation goes up a lot because they're struggling with vaccinations, they're struggling with the spread of COVID and mortality rates. They're going to lockdowns pretty systematically, so the supply pressures are going to continue and consumption will decline.
This has been a great discussion. Thank you so much to Bob Michele of JPMorgan and Saira Malik of Nuveen. When we come back, we'll take a look at what's happening around the world next week on Global Wall Street. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It's time now to take a look at what's coming up next week on Global Wall Street, starting with Juliet Sally in Singapore.
Thanks, David. Investors here in Asia will be focused on geopolitics this week, with President Biden expected to visit Japan for a summit with Prime Minister Kishida on Monday. That is scheduled to be followed by a Quad meeting between the US, Japan, Australia and India on Tuesday. China has continued to eye America's alliance building in Asia with alarm as relations between the world's 2 biggest economies strain further over Russia's invasion of Ukraine. Now over to Danny Berger in London. Danny?
Thanks, Julia. One of the focuses in Europe this coming week will be the continuing story of Sweden and Finland's attempt to join NATO. They had hoped to fast track it and hoped to join the bloc last week. However, Turkey had blocked their application. So questions will linger. Can they get back on track? President Biden last week voiced his support for the 2 Nordic countries to join NATO. This, of course, in the face of Russia's invasion and ongoing invasion of Ukraine. Now over to Romain Bostic in New York.
Thanks, Danny. Coming off another rough week in U.S. financial markets, investors are focused intently on macro conditions. Economic data next week include the U.S. manufacturing and services PMI data, which are expected to show further softening. We'll also get a peek at durable goods orders, which economists expect to have slipped to a growth rate of 0.6% for April from 1.1% a month earlier. 2 separate reports for home sales also on tap, as are personal spending numbers. Remember, in March, inflation-adjusted spending unexpectedly increased, a signal that Americans weren't afraid to dig into savings to keep making discretionary purchases. But a lot has changed in the month since, and that number for the month of April is projected to have reverted back to the year-to-date lows. Throw onto that pile one of the Fed's preferred measures of inflation, the PCE price index, and the minutes from the May 4th FOMC meeting, and investors, they're going to have a lot to digest in the week ahead.
Thanks to Juliet Sally, Danny Berger, and Romain Bostic. Coming up, a housing market caught between shortages of supply and rising mortgage rates. We talk with Tom Shapiro of GTIS Partners. That's next on Wall Street Week here on Bloomberg.
The housing.
Kind of climate.
Housing. We all need it. There isn't enough of it, and prices are going up. Part of the problem is that we never really recovered from 2008, according to Jonathan Gray of Blackstone.
The challenge on housing has been many years in the making. If you step back and look at the supply picture, we have been building housing at half the rate we did prior to the financial crisis.
And the Fed's monetary support for mortgages has helped stimulate the market.
It was very hard to understand why, when we were in the midst of the biggest house price run-up ever, that the Fed was buying mortgage-backed securities on a substantial scale.
But now mortgage rates are pushing the other way, climbing back up over 5%, driving the housing sentiment index down the most since the pandemic, which leads Wells Fargo CFO Mike Santomassino to anticipate softening in the market.
I think we've seen, if it's not the largest increase in mortgage rates in a quarter ever, it's pretty close. And so I think that's definitely going to have an impact on the mortgage market.
And this week's mortgage applications seem to prove that point. Down 11%.
People are not entering into contracts or trying to buy homes anymore because it costs too much.
And to take us through this housing market, we welcome now Tom Shapiro. He's President and Chief Investment Officer of GTIS Partners. They manage about $4.3 billion in real estate assets. Tom, thanks so much for joining us on Wall Street Week. First of all, I want to start with your take on where the housing market is right now. We've seen some slowing even this week with some new housing sales as well as existing housing sales.
Sure. First, thank you so much for having me on the show. Why don't I just give you a little anecdotal evidence of what we're seeing in the field right now. Our home sales are down about 15 to 20%, but that's a headline number. And, I think it'll be helpful to kind of dig a little bit deeper into that number. The reason, for the most part, it's down is because we can't deliver homes. We're still having tremendous supply chain issues. Also, we find that a lot of home builders are actually holding back on the number of homes they want to deliver. And that is for a couple of reasons. One, inflation, because costs keep going up and they don't know what it's going to actually cost to finish the house. And two, they want to ride up the home price appreciation. So I would say for the most part right now, while we see a 15 to 20% slowdown in sales year over year, a lot of that is because of other extraneous issues. It's more of a delivery issue than it's a demand issue. With that said, we're definitely starting to see a pullback. We're starting to have to go deeper into our wait lists, but every house at this point that we deliver in the markets we're in, we are selling. But I think we have to be careful about what we see, on a going forward basis, because definitely we're starting to see things slowing down.
That's a really helpful way of putting it up, because we're having those discussions about the overall economy. Is it supply? Is it demand? As I understand it, you've got a supply problem because of supply chain. People say that's going to go away. Is it going away in housing?
Well, it's not. I mean, we definitely have issues. We have problems getting trusses and windows and appliances. We're delivering homes with plywood windows at times. We're having all sorts of issues. And of course, the war in Ukraine and what's going on in China and the work stoppages there. The deliveries and transportation is an issue, and jobs are an issue, and trades are an issue. So it's gotten marginally better, but we still have tremendous supply chain issues. And look, if you look at how many houses we're delivering a year in total, this is all forms, it's about 1.2 million housing units a year, which is sort of in equilibrium.
So Tom, some of the issue can be on the demand side. At some point, we've heard about mortgage rates going up to, 5.5%, something like that. So that must affect it to some extent. Are you seeing some effects with that? Because we also have the Fed is going to start selling off some of those mortgage-backed securities.
Yeah, for sure. I mean, look, the consumer's stretched. So why are they stretched? They're stretched because of inflation. So we have all sorts of issues. We have gas prices are more expensive, and we have the cost of food is more expensive. And of course, as you point out, mortgage rates are an issue. So the consumer is stretched, and that is certainly going to be an issue on a going forward basis on housing. But we are seeing, people taking less options. They're going to slightly smaller unit types, and they're renting. So we aren't necessarily seeing a slowdown at this point because of mortgage rates. But again, I think we have to be careful. I think, the crystal ball says it's going to get a lot worse. We're not seeing it today, but I think in the future, we are going to see a slowdown. And as I mentioned, the 15 to 20% or so we're seeing year over year decline at this point isn't a demand issue. But I think we shouldn't kid ourselves that we are seeing it. Again, our traffic's down in a lot of our communities. it is starting to slow down. So I think we're going to start to see the slowdown come in the next couple of quarters.
When you say things are going to get worse, a lot of us go back to 2008, the last time we really thought hard about a housing crisis in this country. And there are some anecdotal incidents where it sort of feels like 2006, 2007, where people are outbidding each other for houses. They're going way above the asking price. Are there parallels with what happened in 2008?
It's a really, really good question. So why don't we go back in history? Because I think, we really have to analyze where did we end up in 08 and why did we end up there? So if you look back to 2005, we produced 2 million housing units. So in general, we produce 1.2 million households a year. What's a household? Your kid graduates college and moves into an apartment. A couple moves out of their parents' house and they take an apartment. There's a divorce, et cetera, and that creates a need for housing units. So against a total need of 1.2 million units, we produced 2. And then it did slow down because remember after 05, even before the GFC, we started to have a housing slowdown. We still produced 1.5 million housing units. So we had a massive oversupply going into then a demand shock. So it was really the perfect storm. And that is why we ended up with the global financial crisis. So in those days, we just had a massive oversupply and then we had demand just fall through the roof, fall through the floor. So that is why we ended up in the GFC, and that's why we ended up with a massive oversupply of housing. At that point, people thought there'd be 8 or 9 million foreclosures. We actually didn't believe that number because fundamentally, we don't believe that if your house goes below your mortgage value by 5 or 10%, that people are going to walk away from the house. So we actually, at that point, started to buy housing lots. Why do we buy housing lots? They have tremendous convexity. If a home price goes down 10%, housing lots go down 20%. There's some point where if you're going to build a house that costs $200,000 that's worth $180,000, the lots are theoretically worthless, although of course they have some option value. Household formations also dropped through the floor, and that's because people doubled and tripled up. People moved into their parents' basements. There was such tremendous unemployment. So we started to see that at some point when the housing recovery happened and the economy started to recover, people would start to move out of those units and create households again. So that's why we did it, and we thought it was the best way to play the recovery. So fast forward to today. Today, we have, the last time mortgage rates were at this level, we had 1 million more housing units. We have, in a lot of markets, 1 to 2 months of supply. So right now, supply is not an issue. We have very, very little supply in this market. But of course, we're looking at the demand side now, and as you point out, mortgage rates are up. As I said, the consumer is stretched. So there's no question that there's going to be a demand shock. But there isn't the supply issue that we had in 08, which is why we feel pretty confident that we're not going to see a GFC type situation in housing as we did before. Now, look, we have a lot to worry about. We're clearly heading towards a recession, potential recession with stagflation. So, there is a lot in the economy. We're starting to see consumers pull back. We're starting to see corporate earnings come off. We're starting to hear about potential layoffs. We're starting to hear about jobs, jobs being decreased, and as well as wages going down, which is all problematic.
Yeah, so Tom, here on Wall Street, we'd like to get some free investment advice if we could. So given all that you just said, where are the investment opportunities? I know recently you said, I believe, you want to sell old and build new. Is that still true?
Yeah, for sure. I mean, we think, I'd say a couple of things that we're looking at right now. We are very concerned about older housing stock, particularly in multifamily garden style apartments. We think that people don't necessarily want to live in those type of units today. People clearly in a post-pandemic world are going to have some level of work from home. And given that they're going to work from home, they need a different type of unit. So we are doing a lot of what we call build to rent. And they're actually single family homes in a whole community where they are all for rent. So they could be 200-300 units of single family homes. They could be 1 bedrooms. Generally the 1 bedrooms are conjoined, but they have a little backyard, 2s and 3 bedrooms with a really nice amenity package, including a shared workspace where if the couple is in the house and one needs to be on Zoom and the other one needs to be doing work, they can actually go into a shared work environment. So we are definitely looking into that, and we like that a lot. And that also, I'll throw up their rents. So look, as things get more expensive for buying, we think, and rents have gone up as well, but we do see really strong demand on the rental side. Again, we still see very good household formations, and people will make a lifestyle decision first and a financial decision second. So they'll decide, I want to be in a house, I want to be in an apartment, I want to be in a mobile home. So they make that decision first, and then they say, am I going to buy or am I going to rent that? So we're seeing more and more demand on the rental side. So a lot of what we've been shifting to, we still do a lot of home building, and we still really like that sector a lot, but we're also looking at build to rent communities as well, because we think that more and more, especially as mortgage rates go up, we're going to see more people renting. And we are in a sort of Uber Airbnb generation where people like to rent things, they don't necessarily own things as well. So we're not seeing the same desires of home ownership as we did in the past.
Tom, thank you so much for joining us on Wall Street Week today. That is Tom Shapiro of GTIS Partners. Coming up, we wrap up the week with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. We are joined once again by our very special contributor on Wall Street Week. He is Larry Summers of Harvard. So, Larry, this was quite a week in the markets. You saw equity markets really selling up rather substantially. It's got a lot of people nervous. Is that going to help or hurt the Fed's effort to address inflation?
I think it's part of the Fed's efforts to address inflation. The way monetary policy works is by raising the costs of capital and discouraging investment. The way it works is by reducing wealth, which reduces spending. This is part of the process. This is a feature, not a bug, associated with the tightening of monetary policy that we've had. And the reason I've been reasonably confident that the economy will slow down, but not so confident about just where interest rates will go, is because of the uncertainty about what economists call the transmission mechanism, how large a decline in markets, how much of a discouragement of housing you get as rates go up.
Well, to that very point, what is the risk from where you see it right now of the Fed essentially getting cold feet as we see the markets really come off substantially, S&P now really in bear market territory? What's the risk that they'll let up too soon on the interest rate hikes?
Look, there are two risks in a situation like this, that we overshoot the runway and that we land the plane too hard. And those are both very real risks in this situation. It's a very, very difficult landing that the Fed's attempted. As I've said on your show before, David, there's never been a moment when we had unemployment below 4 and inflation above 4 when we avoided having a recession within the next 2 years. And that just goes to show the huge difficulty of the task that is before the Fed. And my own judgment is that it's distinctly more likely than not, probably 2 and 3 or 3 and 4, that we will have a recession that will start sometime within the next 2 years.
When we look at the markets right now, a lot of this reaction we think is a reaction to the possibility of higher interest rates. Is it possible it's actually bleeding over into the underlying economy itself? Because we also saw some retail sales numbers that concern people from Walmart and from Target this week. Maybe people aren't spending as much money. We also have seen some softening housing numbers. There are various indications. And by the way, a lot of the things that people are buying, they're buying with increased credit card loans.
So I think that the prospect of recession is looking much more real to markets right now than it was a few months ago. You see that in the way in which certain retail stocks have been hammered. You see that in the way some credit spreads have widened. And it's just, you see it in the behavior of the overall market. So I think you still have more room to go. And as I say, I do think we're unlikely to get out of this with sustained expansion.
There are some thoughts there are other ways as well to address the inflation problem. One of the suggestions is increasing corporate taxes. That's something suggested by President Biden. Mr. Bezos of Amazon came out against that. You had a little bit of a disagreement on Twitter this week.
Yeah, look, I've been hardly consistently supportive of everything the White House has said on fiscal policy, and I haven't been consistent with everything they've said on policy towards business either. And I've got great respect for Jeff Bezos as a business leader and as an observer of the economy, but I didn't really see his point. It seemed to me that it was pretty natural to raise corporate taxes so as to reduce spending when you had an economy that was overheating. And it seemed to me pretty reasonable strategy to try to raise taxes to reduce spending in ways that would affect the most fortunate people in the society. And it seems to me that that's what President Biden is trying to do, and that's what he pointed up in his remarks. So I didn't understand why Jeff Bezos was suggesting that they were somehow an obfuscation or somehow an inappropriate kind of commentary. You can agree or disagree with the president's policy, but I found Bezos's comments to be somewhat off base.
Another way that President Biden is suggesting we might address some of the inflation problem is by more vigorous enforcement of antitrust laws. We had the Assistant Attorney General for Antitrust this week come out and say he thinks he's got some problems with private equity. What do you make of the efforts at the FTC and the Department of Justice on antitrust front?
I'm very worried about whether they are in the right direction. I don't think there's any question that we need to step up antitrust enforcement in America. I don't think there's any question that there are areas where we have too much monopoly power that should be prosecuted, principally where individual firms are merging to get excessive market shares in particular industries. And the budgets of those agencies have been allowed to erode in ways that are quite damaging. What I think is badly misguided and potentially dangerous to our economic future is the set of doctrines that people jokingly refer to as hipster antitrust, or the new Brandeisians after Justice Brandeis. That's a theory that says antitrust shouldn't be about maximizing benefits to consumers, but should be about some other different set of abstract objectives. And I think that tilts very easily into a kind of dangerous populism. If the head of the antitrust division thinks that there are mergers that are headed towards monopoly, he should try to block those mergers. If the head of the antitrust division believes that there are companies that are engaged in inappropriate exclusionary business practices, he should prosecute those companies. But I don't understand what his argument is that whether a firm is owned by public shareholders or private equity shareholders should be dispositive. If he's saying that all the private equity firms are colluding on particular deals, I understand that argument. And if he can prove that argument, it would obviously be a serious problem. Right. But it frankly sounded rather like some of the populist rhetoric that the FTC commissioner, Lina Khan, has engaged in. Right. And I think it's very important that we have antitrust policy based on facts, based on economic science, based on consumers, not on a kind of generalized feeling of hostility and outrage towards business. And I'm frankly worried about that.
Okay, Larry, one quick one here at the end. There was a big objection from the shareholders to Jamie Dimon's compensation. There was a $50 million bonus that they were going to pay him that they really objected to. What did you think of that?
Look, I think taxes ought to be more progressive. And so Jamie Dimon and everyone else who makes a lot of money ought to be paying more in taxes. It ought to be much harder for them to pass large fortunes to their kids. But God, if you look at what Jamie Dimon has contributed to the market value of the share owners of JPMorgan. I don't think there's anything unreasonable about his being paid and making as much money in a year as a really great pro golfer. And so I was surprised at those objections. I think the way to get at issues of inequity is to have more progressive taxation, more burdensome taxation on estates, get rid of a whole set of loopholes, but driving people out of leading public companies into the private sphere, away from public companies. I don't think that's smart strategy for our country.
Okay, thank you so much. Always great to have you with us. That's Larry Summers of Harvard, our very special contributor here on Wall Street Week. Coming up, you already know about the long list of risks you're facing right now, but is there one you might be missing? One that is literally out of this world. This is Wall Street Week on Bloomberg. Finally, one more thought. The unknown unknown. That's what Donald Rumsfeld warned about when he was defense secretary. There are things we know are issues but don't know the answer to, and then there are the things we don't even know we don't know. Right now, investors face their fair share of known unknowns, like where inflation is heading.
You know it's not going to be good for a while.
Whether we're facing a recession next year.
Every single American worker is going backwards right this minute.
Whether China's problems with COVID will continue our supply chain problems.
Clearly, China's industrial might was slowed by the lockdowns.
What the end game is for Russia's war with Ukraine.
I think the off-ramps have gotten slightly narrower.
And, of course, whether we're facing another wave of COVID.
Cases are rising, hospitalizations are rising.
But those are the known unknowns. Congress has now added an unknown unknown to the list we need to be worried about: UFOs. The House Intelligence Committee's Subcommittee on Terrorism held hearings this week to get some answers on unidentified flying objects.
We have seen an increasing number of unauthorized and/or unidentified aircraft or objects in military-controlled training areas and training ranges and other designated airspace.
And in case you wonder why our Congress, with so much else on its plate, has decided to take up the question of UFOs, fear not. It's been on the case for over 50 years now, dating back to Gerald Ford, not when he was president, but when he was House Minority Leader, and organized a hearing after complaining that testimony from an Air Force expert calling reported sightings swamp gas was flippant. So as you go through your portfolio and consider the upside and downside risks, you might want to include the possibility of alien intervention. That, as Rod Serling put it, we've moved into a land of both shadow and substance.
Between light and shadow, it is an area which we call the Twilight Zone.
I'll leave it to you to decide whether that's a risk to the upside or a risk to the downside. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.